Let's clear up the most popular Southeast Asian bedtime story. Malaysia did not kick out Singapore in 1965 like an angry landlord tossing out a noisy tenant. That version is emotionally satisfying, politically convenient, and economically illiterate. History textbooks love it because it removes responsibility from everyone still alive. What actually happened was far more embarrassing. Capital left first, talent followed, the island just stayed open. Back in the 1960s, Malaysia had land, resources, labour and population. On paper, it should have dominated the region for decades. Rubber, tin, palm oil, ports, geography, the whole starter pack. Singapore, on the other hand, had no natural resources, no farmland, no water, no hinterland, no emotional attachment to excuses. What Singapore did have was something Malaysia kept treating like a side quest: rules. From day one, Singapore optimized for capital safety, not culture, not slogans, not national identity. Capital doesn't care about your feelings. Capital asks 3 questions. Will my money be safe? Can I get it out? Will the rules change after lunch? Malaysia never answered those questions cleanly. Instead, Malaysia offered ethnic-based economic policy, political risk premium baked into every deal, property rules that change with elections, stock markets that move sideways while inflation eats quietly. So capital did what capital always does. It left. Calmly, politely, without press conferences. By the 1980s and 1990s, foreign direct investment, regional headquarters, banking operations, shipping finance, insurance desks, and eventually real estate money started clustering in Singapore. Not because Singapore was better, because Singapore was predictable. And here's the part Malaysian nationalists hate hearing. Singapore didn't steal anything. Malaysia priced itself out of trust. Look at property as the first warning sign. In Kuala Lumpur, property became political. Foreign buyers restricted, local ownership quotas, developers tied to politics, pricing distorted, yield uncertain. In Singapore, property became a financial instrument. Clear title, transparent tax, brutal stamp duties that protect the system. No ambiguity about ownership. Capital loves clarity more than low prices. Same story in stocks. Malaysia's stock market became a parking lot. Dividends decent, growth limited, valuations capped by policy uncertainty. Retail investors trapped in patriotic optimism. Singapore turned its market into a holding pen for global money. Banks, REITs, logistics trusts, data centres, infrastructure plays. Boring, profitable, predictable. This is where the myth fully collapses. Singapore did not win because it was aggressive. Singapore won because it didn't lie to capital. And Malaysia? Malaysia kept insisting loyalty should replace incentives. Capital does not do loyalty. Now pause here. If this already makes you uncomfortable, good. That means it's working. Because in the next chapter, we're going to talk about talent, brain drain, and why Malaysia trained people for Singapore's balance sheets. Before that, do the algorithmic ritual. Like the video. Subscribe to the channel. YouTube rewards consistency, not nationalism. If you want the next chapter, you know what to do. This is the part where people start saying things like brain drain in a sad voice, as if brains simply floated away on their own. Brains don't migrate. Incentives do. Malaysia didn't lose talent because Singapore was evil, sneaky, or morally flexible. Malaysia lost talent because it treated skilled people like a renewable resource instead of an asset that needs to be priced correctly. Let's talk numbers, not slogans. A Malaysian engineer, banker, analyst, or IT professional can do the same job in Kuala Lumpur and Singapore. Same Excel, same Bloomberg terminal, same code, same stress headache by Wednesday. The difference is what happens after payday. In Malaysia, wages plateau. Early promotions stall without political or ethnic alignment. Savings grow slowly. Property ownership feels permanently, almost. In Singapore, Wages scale brutally with performance. Promotions are transactional, not sentimental. CPF forces asset accumulation. Property is expensive but legally unquestionable. People love pretending this is about nationalism or identity. It isn't. It's about balance sheets. Malaysia invested heavily in education, universities, scholarships, overseas exposure, engineers trained, accountants certified, finance people polished just enough to be dangerous. Then it did something incredible. It refused to pay market price for them. So Singapore stepped in and said very calmly, "We will." This is where the story gets uncomfortable for policymakers. Singapore doesn't need to train everyone. It just needs to be the final employer of record. Malaysia absorbs the education cost. Singapore captures the productivity. That's not exploitation, that's arbitrage. And arbitrage is what financial systems do when rules allow it. Now let's add property and family into the equation, because this is where decisions become irreversible. A Malaysian professional working in Singapore can earn SGD, save in SGD, buy assets in SGD, live in Malaysia where costs are MYR. That currency gap is a one-way door. Once someone builds assets in Singapore's system, returning to Malaysia means accepting lower capital growth, higher policy risk, fewer global exit options. People don't betray their country, they optimize survival. Singapore understood this early. It never promised happiness, it promised structure. Malaysia promised belonging. Capital and talent picked structure. And here's the brutal truth nobody likes saying out loud. Malaysia didn't lose its best people, it exported them at a discount. Singapore didn't brainwash anyone. It simply wrote clearer contracts. Now, before the next chapter gets even more personal and even more political, do the ritual again. Like the video. Subscribe to the channel. This isn't tourism content. This is economic anatomy. If you want Chapter 3, the algorithm needs proof you're still awake. If you ever want to know whether a country actually respects capital, don't listen to speeches. Watch what happens when someone tries to buy property. Property is not about housing. That's the fairy tale version. Property is capital saying, "I'm willing to stay." And this is where Malaysia and Singapore fully diverged. Malaysia treated property as a political tool, a social engineering device, a reward system, a lever to be pulled during elections. Singapore treated property as a controlled asset class, a balance sheet stabilizer, a macroeconomic shock absorber. Same word. Completely different intent. In Malaysia, foreign ownership rules shift, thresholds change, quotas appear, disappear, reappear, taxes are reviewed, policies are clarified, then re-clarified, then politely ignored. Capital hears only one thing: your exit is conditional. That's fatal. Capital doesn't mind high taxes. It doesn't even mind regulation. What it cannot tolerate is ambiguity. In Singapore, property policy is brutal but honest. Stamp duties are painful and explicit. Cooling measures are transparent. Ownership rules are boringly consistent. The state tells you up front how much it will take. Investors don't complain. They calculate. That's the difference between a system designed for emotions and one designed for spreadsheets. Now let's talk yields, because this is where retail investors get emotionally attached and professionally ruined. Malaysia's property market loves the word potential, future growth, upcoming infrastructure, long-term vision. Singapore's property market loves the word cash flow, yield compression, capital preservation, exit liquidity. One is a promise, the other is a contract. And capital always chooses contracts. This spills directly into banking and finance. In Malaysia, mortgages are exposed to policy drift. Banks price political risk quietly into rates. Developers are leveraged into relationships, not demand. In Singapore, banks are conservative to the point of boredom. Leverage is tightly policed. REITs become income machines, not hope machines. This is why global money parks in Singapore even when returns look low. Low-risk compounds, high uncertainty decays. Malaysia never collapsed. That's the tragedy. It just never fully convinced capital to stay for decades, and once property loses its role as a trusted store of value, everything else follows. Stock market stagnation, currency weakness, talent hedging their future elsewhere. This is not about being rich, this is about being credible. Now, before Chapter 4 exposes how politics traded long-term capital trust for short-term comfort, do the thing the algorithm demands. Like the video, subscribe to the channel. Finance content survives on engagement, not patriotism. If you want the next chapter, prove it. Every country says it wants stability. Very few understand what capital means by that word. For voters, stability means familiarity. For politicians, stability means not upsetting anyone important before the next election. For capital, stability means the rules won't change because someone panicked. This is where Malaysia and Singapore chose opposite poisons. Malaysia chose political comfort. Singapore chose political credibility. Malaysia's system evolved to manage tension, ethnic balance, coalition politics, short-term appeasement, every policy carefully calibrated to avoid rocking the boat. That sounds reasonable. It's also catastrophic for long-term money, because capital doesn't ask, is everyone happy? Capital asks, will this policy still exist after the next election? In Malaysia, answers are often, it depends. We're reviewing it. We'll see how the public reacts. This is temporary. Temporary is poison. Temporary taxes, temporary restrictions, temporary incentives, temporary exemptions. Capital does not build 30-year models on temporary promises. Singapore went the other way. It told voters something deeply unpopular. You will not like all of this. Too bad. Housing restrictions, brutal. Foreign buyer taxes, painful. Labour rules, cold. Retirement savings locked up, non-negotiable. But the rules were clear. And worse for politicians, they were enforced. Capital noticed. This is why Singapore can make policies that look harsh and still attract money. The system doesn't pretend to be kind, it pretends to be consistent. Malaysia kept trying to be kind, and kindness in policy often looks like uncertainty in finance. Now look at the second-order effects, because politics shapes money and money shapes behaviour. In Malaysia, investors hedge by diversifying abroad, families quietly send kids overseas, entrepreneurs register holding companies elsewhere, professionals keep one foot out the door, not dramatic exits, quiet ones. In Singapore, capital commits long-term companies, build regional HQs, financial institutions deepen exposure, talent roots itself financially. This is the invisible divergence people miss. Malaysia didn't experience a crisis, it experienced gradual mistrust. And gradual mistrust doesn't show up on the news. It shows up in spreadsheets, lower valuations, weaker currency, slower capital velocity, sideways stock indices. By the time politicians notice, capital has already priced it in. Now we're almost at the end. Chapter 5 is where this stops being history and becomes forward-looking. What Malaysia could still do, what Singapore must avoid, and why this gap is not destiny, but design. Before that, do what keeps this channel alive. Like the video, subscribe to the channel. Finance content lives or dies by engagement. If you want the final chapter, let the algorithm know. Here's the uncomfortable relief at the center of this entire story. Nothing that happened between Malaysia and Singapore was inevitable. No geography curse, no cultural defect, no historical doom baked into the soil. This wasn't fate, it was policy design, and design can be changed. Let's kill the laziest conclusion first. Malaysia does not need to become Singapore. That sentence alone shows the wrong mindset. Singapore is not a lifestyle brand, it's a financial operating system. Malaysia doesn't need to copy the UI, it needs to rewrite the back end. The real lesson from Singapore is not discipline, or cleanliness, or obedience, or whatever motivational poster people love this week. The lesson is brutally boring. Capital stays where rules outlive politics. That's it. Malaysia's future does not depend on catching Singapore. It depends on stopping the leak, and leaks are always structural. Start with capital trust, not incentives, not slogans. Trust. That means property rules that don't adjust every election cycle. Investment policies that don't depend on which coalition wins, tax structures that are boringly predictable, courts that settle disputes without vibes. Capital will accept lower returns. It will not accept uncertainty disguised as flexibility. Next, talent pricing. Malaysia does not have a talent shortage. It has a pricing problem. When skilled professionals look at their lifetime balance sheet and realize income growth caps early, asset accumulation is slow, global optionality is limited, they don't rebel, they relocate. Fixing that doesn't require speeches about patriotism. It requires making staying financially rational. And here's the quiet irony. Malaysia already has the advantage Singapore can never buy: space, cost, depth, human slack. Singapore runs hot because it must. Malaysia runs warm and refuses to turn the dial. That's not failure, that's unused leverage. Now let's flip the lens, because Singapore isn't immune either. Singapore's model works because it assumes continuous capital inflow, endless talent attraction, global stability. That assumption is fragile. Over-financialization creates its own risks: housing affordability, middle-class pressure, rising inequality hidden behind GDP. If Singapore forgets that its strength is credibility, not superiority, the same capital that arrived politely will leave just as quietly. Capital is loyal to rules, not flags. So here's the final truth that makes everyone uncomfortable. Malaysia didn't lose Singapore. Singapore didn't steal Malaysia's future. The region simply rewarded the system that lied the least, and systems can change. If you learned something from this, or if this made you angry enough to think instead of comment, do the thing that keeps this channel alive, like the video. Subscribe to the channel. Finance, property, and capital analysis don't survive on vibes. They survive on engagement. This wasn't about the past. It was about design choices that are still being made, and whether anyone is brave enough to change them.